Hi Team Value, JJ here, welcome back. Well, Alibaba earnings are out for the March quarter 2024. I'm going to dive right in and see what's been going on as usual with Alibaba earnings, so let's get into it. Let's have a quick look at the price action since earnings. It was down 6% on that first session after earnings, which was disappointing for a lot of shareholders. It's up in pre-market as I'm recording now. It's up a little bit, but it's not all bad news, because if you've been looking at the share price, the Alibaba share price over the past few days and weeks, we can see it's still up 2% over the past 5 days. So even that dip after earnings didn't destroy that. And 1 month it's up 12.59%. So it's been having a good run. Yes, it did go down after earnings. Can it recover as the market digests what's going on? And I've just been through earnings and they weren't too bad. Okay, financial highlights. Let's take a look. Here we can see for the 3 months ended 31st of March and for the 12 months ended 31st of March. So we can see here the Taobao and Tmall group, the biggest, and its year-on-year growth of 5% and 4% for the 3 months. So not impressive growth, and it has been going on like that. So not much difference there. And then the next is a Cloud Intelligence Group, 3%. So Alibaba in these areas has had disappointing growth, and that seems to be continuing. And then next down we have Alibaba International Digital Commerce Group, which is 46% for the 12 months, which is impressive growth, and 45% for the 3 months. Now, I've watched a few earnings videos. I haven't seen anybody mention here. Look at the revenue for this. It's nearly getting up to the Cloud Intelligence Group. So if it's growing at 46%, what's going to happen in the next few quarters? It's going to actually surpass the Cloud Intelligence Group if the Cloud Intelligence Group doesn't start growing more, and they want it to grow more. So now Smart Logistics is also 28%. So these are the big growers. So for the 12 months here, these two units here are doing pretty well, growing really fast. That's the growth area. Because it's growing so fast, these are going to be big groups soon. They're investing in these groups, and with good reason, because they are the growers. And then next down the list is Local Services Group, which isn't so big, but still growing at 19% for the 12 months, and similarly for this past quarter. So growth has been impressive. And then we get down into the smaller sections here. But total segment revenue, we've got 9% for the whole year. So market's not so impressed with this. The stock went down, so it's not into double-digit growth. We'd hope for overall double-digit growth really as shareholders. But 9%, it's not too bad. 8% for the 3 months. So really not too bad, not great, but there are sectors there that are growing. They're getting to be quite big, growing at 46 and nearly 30%. So pretty impressive growth there. And consolidated revenue there, 8% for the 12 months and 7% for the quarter. Income from operations up 13% for the year and down 3% for the quarter. Now net income, I saw that this made headlines because it's 96% down. That's a good headline, isn't it? Over a year it's 9%. The thing about this 96%, it doesn't deserve to be a headline, because we've got diluted earnings per share here. But if you look down here, non-GAAP net income, it's down only 11%, still down, but only 11%, and non-GAAP diluted earnings per share down 5%. Warren Buffett's talked about this GAAP versus non-GAAP. With GAAP income, that includes investment that the company's made, investments, say in public companies, and this figure has to include the ups and downs of the stock market of those investments. So if there's been a gain in one quarter, that has to be recorded, accounted for, and if there's a loss, even if they haven't been sold, so if they've still got the investments, and Warren Buffett and Charlie Munger really hated this measurement, so they preferred non-GAAP. And if we look at the non-GAAP, it's much better. So that 96% really doesn't mean much for the quarter, and those headlines that have said it on videos and in news articles, that really shouldn't have done that, because it doesn't explain what's actually going on in the business. Now let's turn to the section cash return to shareholders, which is pretty interesting. We've got share repurchase. I talked about the share repurchase program that's been going on for some time. As we can see here, repurchase amount in billions. And if we go to the 12 months ended March 31st, 2024, it's 12.5 billion. This one's in US dollars, so 12.5 billion US dollars in buybacks, which is really good to see. If we look at the market cap of the company, it's $193.5 billion right now. So 12.5 billion in buybacks is a substantial amount of the market cap. If we see this line here, they've been consistently buying back, and as I said in the last earnings, they decided to step it up. The same 12 months ended 2023, it was 10.9 billion, so it's been 12.5 billion. So they've been significantly buying back shares. I'm sure Charlie Munger, as he was a shareholder of Alibaba, would have liked to see this. And here we can see net reduction in total shares, and for that 12 months it's 5.1% reduction in total shares, and for the 12 months ended the year before it was 3.9. So as the share price is low, and most people agree that the share price is low, that it's pretty undervalued. The share price has gone way down, well over 75% it went down. And so buying back stock when it's cheap, some companies buy back when the stock is expensive, so they're really taking advantage here and buying back a lot of shares, a good percentage of shares. And if the share price stays down, they could buy back a significant part of the company, being a cannibal, as Monish Pabrai puts it, eating their own stock while the share price is low. So really, if you're a shareholder of Alibaba, you might be disappointed that it's down, but really, if the company's buying back stock like this, and they've got so much cash to do this, so they can really keep doing this as long as the share price is low. And in addition to the share repurchases, the buybacks, and this cash return to shareholders section, we now have dividends. Our board of directors has approved a two-part dividend comprised of 1, an annual regular cash dividend, 2, a one-time extraordinary cash dividend as a distribution of proceeds from disposition of certain financial investments. The aggregate amount of the dividend will be approximately $4 billion. So we've got that $12.5 billion throughout the year and $4 billion. So they've got a significant amount of cash. I don't really like dividends. I'd rather they did not pay this dividend. I know a lot of investors would like to see this dividend, but I would rather that it be like Berkshire Hathaway. Berkshire Hathaway has never provided a dividend. I'd rather they reinvest that money. They've got some growing areas, growing segments. So it's sort of like an admission that they don't know what to do with the cash. It's good that they've got a lot of cash coming out, huge cash flow, and it's kind of like giving back to shareholders, maybe for staying the path to encourage shareholders to invest in the company. People do like dividends, but I would rather see them not do this and just reinvest in the company. Now, if you're getting value out of this Alibaba earnings episode so far, I'd really appreciate it if you remember to smash that like button to help the algorithm to spread it to more people. It really does work. Now, in the business highlights in the Taobao and Tmall group, they say here, our strategy of price competitiveness and focus on user experience is yielding results. During the quarter, we achieved double-digit online GMV and order growth. So this is not revenue growth, GMV year over year, driven by strong increase in the number of purchases and purchase frequency. This is the biggest but slow growth. So they're trying to reignite growth here. They've had some movements around in management, and Joe Tsai's been excited about it, and memos by Jack Ma saying that Alibaba can get its act together. So they want to really reignite this. And here we see some highlights from the cloud intelligence group. We're really looking for signs of growth here, and they do point to that. They say, we are committed to our strategy of focusing on high quality revenues from increasing public cloud adoption while reducing low margin project-based contracts. During the quarter, our core public cloud offerings, which include products such as Elastic Compute, database, and AI products, recorded double-digit year-on-year growth in revenue. So that's interesting to see. That's good to see. Overall revenue, excluding Alibaba consolidated subsidiaries, decreased slightly year over year as we transition away from low-margin project-based revenues. So they're trying to change this around. We expect the strong revenue growth in public cloud and AI-related products will offset the impact of the roll-off of project-based revenues. It's going to be interesting to see if they can get some growth going in there. It's such low growth. If they can get it up to at least double digits and higher, maybe into the 20s like their US counterparts, if they could do that, they've got these other fast growing areas. If they can reignite growth in these two big areas, especially cloud, I think the market would definitely see that as a really, really positive sign. Now, in the Alibaba International Digital Commerce Group, which is one of their really strong growth areas, I'm not going to go through all this, but it is worth diving into seeing what's going on here because it's really positive. For the quarter ended 31st of March 2024, revenue from AIDC grew 45% year on year. And the combined orders of AIDC's marketplace grew 20% year over year. The strong performance was driven by growth in AIDC's cross-border businesses. In particular, growth contributed by the choice business on AliExpress, and we get AliExpress where I am in New Zealand. We are committing more resources to cross-border e-commerce because of the clear customer proposition of price competitiveness and timely delivery to customers around the world. So really going from strength to strength, this business. And as I said, it's not going to be long before it passes cloud. If cloud can't grow, the revenues from this are going to pass cloud. And that's going to be, I thought it's going to be interesting what the market thinks when that happens, because if it keeps growing at 45%, that's going to happen soon. And now Cainiao Smart Logistics, which is another growth area. And this is one that they were thinking of spinning off IPO, or they're planning to, but market conditions didn't allow it. They wouldn't have realized value, which was the whole point. And I don't mind that they've cancelled those. I'm not sure it was a great idea to begin with. So the highlights for this, for the quarter ended March 31st, revenue from Cainiao grew 30% year on year. So pretty impressive. Primarily driven by revenue from cross-border fulfillment services supporting AliExpress. So these two together, really strong together, and they're growing fast. And they talk about the public offering here. In March, Cainiao withdrew its initial public offering on the Hong Kong Stock Exchange in order to align its business to better realize strategic synergies with our e-commerce businesses. Yep, synergies, they do work together. Synergies is an overused word, but these do really work together, and that they pulled the IPO because of market conditions, but maybe it'll be a good thing long term if they hold on to them. If they grow strongly, which they are, it could be a really good part of the business, the overall business. And then we've got these other smaller ones. I won't go through those, that they're sort of immaterial at this point, but some of them are growing well. But we would like to see the overall revenue of 8% for the 12 months. We would like to see in the next year that go at least into double digits, strongly into double digits. I think a lot of shareholders would like to see that. I am a shareholder of Alibaba, a bag holder, willing to stay for the long term. What I'm seeing here is not disappointing. Yes, the growth could be better, especially in those two big sectors that lead, where the cash flow does come from, strong cash flow, and they're able to give a dividend, they're able to buy back shares, and they're able to invest into these growing areas. So really, it's not too bad, not fantastic. They didn't knock it out of the park. Everybody's waiting to see a reignition of growth. We didn't see that, but still not too bad in this quarter. And, I'm willing to hold here and just see how it goes. Now, in the Art of Value Patreon community this week, I'm going to talk about Alibaba earnings, some more things that I don't share anywhere else, more thoughts on the videos I made this week, including these earnings. And I usually do that towards the end of the week. So if you want to check that out, I'll put a link in the description and see you over there. Now, I'm going to put some related episode links in the description. And if you're watching this on YouTube, I'm going to put 2 here to related episodes that I think you should see if you haven't seen those already. So go and see those now if you want to. And thanks to everybody for watching or listening, and I'll see you in the next one.